Welcome back, finance fans. Let us continue the third segment of alternative methods of communication. Telemarketing, an alternative communication method. Attracting new customers is often accomplished through telephone solicitations or cold calling. To combat abuses, Congress passed the Federal Telephone Consumer Protection Act of 1991, which applies to both wired and wireless telephone numbers. The industry has incorporated the main provisions of this law into its SRO rules, including the following. Telephone solicitations may only be made between 8 a.m. and 9 p.m. local time of the party being called, unless the person has given prior consent or the party being called is another broker-dealer. When calling prospective customers, callers must provide their name, the entity or person on whose behalf the call is made, a telephone number or address where that entity or person may be reached, and that the purpose of the call is to solicit the purchase of securities or other related services. This information must be provided promptly and in a clear and conspicuous manner. Each broker-dealer is responsible for creating a do not call list. If an individual is solicited by telephone and requests not to be called again, the broker-dealer must add that number to the list. Under FINRA rules, broker-dealers are required to honor a person's do not call request within a reasonable period, which cannot exceed 30 days from the date the request was made. Additionally, the firm must train its registered personnel to use the list properly and must establish a written policy to describe how the list will be maintained. Registered representatives may not make calls that harass or abuse the person being called. Examples of prohibited behavior include using language that may be interpreted as threatening or intimidating, using profane or obscene language, or causing a phone to ring repeatedly with the intent to annoy, abuse, or harass. When a broker-dealer engages in telemarketing, it is required to ensure that its outbound telephone number is not being blocked by the recipient's caller identification service. The rule prohibits the use of pre-recorded messages unless the broker-dealer has received the caller's prior written permission. FINRA recognizes that when a representative has an existing relationship with a customer, it may be important to contact the client outside the 8 a.m. to 9 p.m. window. Therefore, the time of day and disclosure requirements do not apply to calls made to clients with whom the firm has an established business relationship. However, the purpose of these calls must be to maintain or service the existing accounts of the firm. An established business relationship between a broker-dealer and a person exists when one of the following conditions is met. Within 18 months prior to the telemarketing call, the person has made a securities transaction or has a security position, a money balance, or account activity with the broker-dealer or its clearing firm. Within 18 months prior to the telemarketing call, the firm making the call is considered the broker-dealer of record for the account. Within 3 months prior to the telemarketing call, the person has contacted the broker-dealer to inquire about a product or service offered by the firm. National Do Not Call List. When a person registers her telephone number on the Federal Trade Commission's FTC National Do Not Call Registry, an RR is prohibited from contacting her. Firms are required to update their Do Not Call list by contacting the FTC and adding any telephone number that appears on the national list. However, one exception to the prohibition is when the person to be called has given prior written consent to be contacted by the member firm. Another exception is based on a personal relationship that exists between the RR and the person to be called, such as a family member, friend, or acquaintance. Safekeeping of customer funds and securities. Several SEC rules are designed to protect customer funds and securities that are in the possession of broker-dealers. The Customer Protection Rule, SEC Rule 15C33, the Customer Protection Rule, contains provisions to ensure the safekeeping of both customer securities and customer funds. The rule defines a customer as any person for whom the broker-dealer holds funds or securities, but does not include another broker-dealer, a partner, officer, or director of the broker-dealer, or a subordinated lender. Customer securities. A broker-dealer is required to promptly obtain and thereafter maintain physical possession or control of all fully paid and excess margin securities that belong to its customers. The term control of securities means that the securities are under the direct control of the broker-dealer. The rule defines several sites as good control locations, including the office of the broker-dealer, in transit between its offices, or in an SEC-approved depository, for example, the DTC. Excess margin securities are defined as those securities whose value exceeds 140% of the debit loan balance of a customer. For example, A customer who owns stock worth $10,000 and has a debit balance of $5,000 would have excess margin securities worth $3,000, $10,000, 140% x $5,000. On a daily basis, as of the close of the preceding business day, a broker-dealer is required to compute the quantity of fully paid and excess margin securities that are in its possession or control, and those that are not in its possession or control. The broker-dealer is required to take affirmative action to promptly obtain possession and control of the required amount of securities. If a customer sells securities and fails to deliver the securities within 10 business days of the settlement date, the broker-dealer must buy in the customer. Under exceptional circumstances, the broker-dealer may apply to FINRA for an extension. Customer-free credit balances. SEC rules require broker-dealers to advise their customers regarding their free credit balances at least quarterly. Free credit balances represent the funds that are available to customers but are currently on deposit in their accounts. For example, sales proceeds that haven't been reinvested or withdrawn. Customers must receive written notice of the amount due to them, along with a statement that the funds are payable on demand. The notice is also required to state that the funds are not segregated and may be used in the conduct of the broker-dealer's business. If the broker-dealer sends statements to its customers more frequently than quarterly, notification of the free credit balances must be sent with each statement. A broker-dealer is not required to comply with these provisions if it segregates customer-free credit balances in such a way that prohibits their use by the broker-dealer. FINRA rules. While the SEC has created most financial responsibility rules, FINRA has additional regulations designed to enhance the fiscal security of its members and their customers. Disclosure of financial condition. Member firms are required to send balance sheets to customers every 6 months and, upon request, make available a copy of the firm's most recent balance sheet. A customer is defined as any person who has funds or securities in the possession of the member firm. Fidelity bonds. FINRA members required to join the Securities Investors Protection Corporation, SIPC, must maintain a blanket fidelity bond, essentially an insurance policy that covers officers and employees. This bond provides protection against loss due to fidelity, on premises or in transit, forgery and alteration, including check forgery, securities loss, including securities forgery, and counterfeit currency. The bond must include a provision requiring the carrier to promptly notify FINRA if the bond is canceled, terminated, or substantially modified. Business Continuity Plan, BCP. What steps must a member firm take when faced with a catastrophe such as flooding or a terrorist attack? Although a member firm's WSP manual establishes its day-to-day policies and procedures, FINRA requires members to have plans in place to address unexpected events. Broker-dealers must establish a written business continuity plan that identifies the procedures to be followed in the event of an emergency or significant business disruption. These procedures must ensure that all customer obligations are met and must address the firm's existing relationships with other broker-dealers and counterparties. The plan is required to be reviewed annually in light of any changes to the firm's business structure, general operations, or location. While the BCP does not need to be filed with FINRA, it must be made available to an SRO upon request. Although many elements comprise a business continuity plan, at a minimum, the plan must address the following concepts: data backup and recovery, financial and operational assessments, alternative communications between the firm and customers, as well as between the firm and employees, alternative physical locations for employees, regulatory reporting, and communications with regulators. Each member firm must provide its SRO with emergency contact information, including the designation of 2 emergency contact persons. At least one of these individuals must be a member of senior management and a registered principal of the member firm. If the second contact is not a registered principal, she must be a member of senior management with knowledge of the firm's business operations. FINRA Rule 4370 also specifies that both emergency contact persons must be associated persons of the member firm. In the case of a small firm with only one associated person, for example, a sole proprietorship without any other associated persons, the second emergency contact may be either a registered or non-registered person from another firm who is knowledgeable about the member firm's business operations. Possible candidates for this role include the firm's attorney, accountant, or a clearing firm contact. Client disclosure. Each member firm must disclose to its customers how its business continuity plan addresses the possibility of a future significant business disruption and how the member plans to respond to such events. This disclosure must be provided in written format when an account is opened and posted on the member's website. Books and records. The SEC and SROs rely on broker-dealer records and reports to monitor compliance with industry rules. Therefore, it is critical for a broker-dealer to maintain accurate records and file timely reports. SEC Rule 17A3 mandates broker-dealers to create specific records, while Rule 17A4 requires those records to be retained for a certain number of years after their creation. Records may be categorized into those that must be retained for the life of the firm, those for 6 years and those for 3 years. Please note that all records must be maintained in an easily accessible location for the first 2 years of their existence. Important to note, lifetime records include corporate or partnership documents. 6-year records consist of blotters, records of original entry, municipal complaints. FINRA requires that complaint records be maintained for 4 years at the OSJ, new account forms and powers of attorney. Records kept for 3 years include trade tickets, confirmations, statements, Forms U4/U5, employee records, all communications, trial balances, etc. Conclusion. The goal of this important video was to provide details regarding many of the requirements that ensure the smooth operation of a brokerage firm. Firms must adhere to KYC rules, AML rules, privacy and record-keeping requirements, as well as the processes for handling various forms of communication. The next video will explore activities that are prohibited for member firms. As we conclude this segment, we invite you to show your support by liking this video and subscribing to our channel. It only takes a simple click for you, but it means significant support for us, and it is completely free. Please turn on your notifications to be among the first to experience the next segment. Thanks.